All right, good morning, everyone, and thank you for joining us this morning. My name is Ashley Leslie. I'm one of the directors here at Vincent's in the Restructuring and Recovery Division. And on my left here is Gavin Dudley, one of the directors from our Lending Solutions Division here at Vincent's. This morning's webinar, as you know, is on the small business restructuring process. Sorry, okay, there we are. So before we begin, I just wanted to take a moment to give an acknowledgement to country. So Vincent's wish to acknowledge the traditional custodians of the land on which we meet today, the Yagara and Turrbal people, and to pay our respects to their elders past and present. We extend that respect to Aboriginal and Torres Strait Islander peoples here today. So before we continue on, could I just ask, unless you have a question, that you just mute mics just so that we don't have any outside interference. You will be able to ask questions as you go through. You can pop it in the chat window, is probably the easiest way to do it. And we can have a look at the questions at the end of the session, unless you've got one that we can do along the way as well. So today's webinar is obviously on the small business restructuring process. We're going to be looking at firstly what it is and who is eligible to enter into that process, how it works, including the plan, implementing the plan and the acceptance period, some of the benefits of entering into the process, some statistics on the processes that have gone up to date. We're going to have a look at a couple of case studies that Vincent's have been involved with in the recent past. And then I'll be inviting Gavin to give some information on how our Lending Solutions division can assist with the before, during and after of an SBR process as well. Okay, obviously today's session is not designed to be any specific advice, and it's just general advice. So if you have any specific questions on any clients that you might like to run by us, please get in contact and we can have an individual consultation with you. Okay, so as I mentioned before, my name's Ashley Leslie, for those I haven't met. The other directors in the Restructuring and Recovery Division here in Vincent's in Brisbane are Nick Combis and Stephen Stats. You may have come across them in your day-to-day life so far. Okay, so what is the small business restructuring process, more affectionately referred to as the SBR? So the SBR process was introduced on the 1st of January 2021. It was introduced on the back of COVID, and it was designed to enable companies to restructure debts more easily with less expense. Australia traditionally has used more creditor in possession style of insolvency model, meaning that the insolvency practitioner is then stepping in as an agent of the company, and the directors then cease control of the company themselves while the insolvency process is going on. On the other side, though, the SBR process is actually a debtor in possession model where existing debts are restructured, but the company remains under the control of its directors. Okay, so who is eligible to enter into an SBR process? Firstly, it's only available to companies. So the entity must be incorporated under the Corporations Act. The unsecured debts or the provable debts of the company need to be less than $1 million on the day that the company enters the SBR. And that excludes any employee entitlements, because one of the other criteria to be able to be eligible is that employee entitlements that are owing must be paid up to date before the process can commence. The tax lodgements for the company need to have been brought up to date, and that's any lodgements that are owing due before the commencement of that. So not necessarily if you're partway through a period, that would be handy to have done, but it's not essential. But all of the ones that are definitely due prior to the commencement need to have been lodged. The company needs to be insolvent. That's a pretty important point. So the directors need to have resolved that the company is either insolvent or likely to become insolvent in the near future. The company must not have already been subject to an insolvency appointment or a restructuring plan, so it can't be doing it concurrently like some of the other insolvency processes can be run. And the company can't have been involved or subject to an SBR or simplified liquidation in the previous 7 years. And that extends also to any entities that have a common director. So that may exclude some entities. Those, though, that are part of a group that may require an SBR process to be run at the same time, they're all suffering from the same fate. There is an ability for companies in a group to go through the SBR process as long as the start or the commencement of that process for all of those entities in the group are occurring at the same time or nearly at the same time. So the SBR process is divided into 2 distinct phases. The first being the appointment of a restructuring practitioner. Very important. And then once that's occurred, then it moves into the development and implementation of a restructuring plan. Before it begins, though, who is a restructuring practitioner? So the current provisions are that a registered liquidator is the only person permitted to act as a restructuring practitioner. Now, there is a special class of registered liquidator that was brought in when this process began, and that special class of liquidator is permitted to carry out SBRs only. So it can be one of those kind of practitioners, registered liquidators, or a liquidator who can administer any type of corporate insolvency appointment. So once a restructuring practitioner has been located, the directors resolve that the company is insolvent or likely to become insolvent, and that a restructuring practitioner should be appointed. Directors set a fixed amount of remuneration in relation to the initial phase of the restructuring plan. And generally that is a fixed fee for the period that is agreed with the restructuring practitioner before the process begins. So then the restructuring practitioner will evaluate the financial position of the business before they can implement the plan. Once the SBR process has kicked off, ASIC is notified of the appointment of the SBR. So the status of the company on the ASIC register changes from being registered into EXAD or in external administration. And that position will remain there until such time as the company actually enters into the plan, as once it's been accepted by creditors. And once it has been accepted by creditors, the ASIC register actually reverts back to being in EXAD. So it is very important if you have clients out there who are dealing with suppliers and customers, that sort of thing, that when they're doing some due diligence into who they are transacting with, that they might have to dig a little bit deeper because it won't be obvious from the outset that the company may be subject to a plan if it's already passed through that initial phase and reverted back to being registered on ASIC's register. Important note too, a restructuring practitioner is not liable for any of the trading debts that occur whilst the SBR process is in place. That's a little bit different to the voluntary administration and liquidation processes, where any trading debts are a personal liability of the insolvency practitioner that is appointed. In this case, the liability remains with the company and the directors of that company. Okay, so the restructuring plan itself, it is a formal document. There is a template provided by ASIC that is somewhat cumbersome, I guess, when you start looking at it. But the more you look at it, the easier it becomes to work through. The plan, it does detail what the assets of the company that are to be dealt with, any third-party contributions that are to be made towards the payment plan itself, whether the plan is to be made from future trading profits. It also details how the restructuring practitioner will be paid. So it sets out the percentage, usually a percentage of the contributions that will go towards the restructuring practitioner's remuneration. It will detail the estimated creditors that are subject to the plan, and it will also then provide an estimated dividend rate for those creditors if the plan is accepted. It's important to note that the plan itself cannot run for a period exceeding 3 years. And our experience for the ones we've done to date is the shorter the period, the more likely it is to be accepted. And that's obviously due to the reduced risk of compliance with the plan. The shorter the period, the easier it is to comply with it. There have been options where companies have put forward a mixture of an upfront payment and then the balance paid over time through a payment arrangement. That's generally acceptable as long as it's achievable. So it's very important the plans are achievable, because if in the event that the company isn't able to meet the plan terms and they find that going forward it's really going to be a difficult thing to do, then the restructuring practitioner needs to terminate that plan. And if it is terminated, there isn't an ability for any kind of adjustment to the terms. It's simply terminated. That allows then creditors to work through an actual winding up of that entity if that's the way they'd like to go. But it does, you sort of terminate instantly and put the company back to the status it was before the SBR process began. Okay, the implementing of the restructuring plan is obviously done by the restructuring practitioner once it has been approved by creditors, and we'll step through that process in just a moment. The plan itself may involve a variety of changes, such as restructuring of company debts, selling of assets that may not be critical to the continued operations, or changes to the day-to-day operations of the company itself. The restructuring practitioner must send the plan to all creditors who are eligible to receive it within 20 business days of the appointment commencing. And when I say that it gets sent to all creditors eligible, if there is the situation where there are creditors who are essential for continued trade, it may be that those creditors actually can be singled out and receive payment in full prior to the SBR process commencing. And what that does is it takes them out of the SBR process altogether. They don't receive notice of the SBR appointment, and they don't participate in the voting. So it's only those that would be provable if it was in liquidation or in administration, and they're the only ones that are eligible for voting on the plan that's put forward. While the restructuring practitioner is not legally required to provide a recommendation to creditors, generally they will give an indication on what their views are, and certainly they do provide some feedback to creditors on whether an SBR is more appropriate or more beneficial to creditors to pursue than a liquidation would be, and sort of set out a bit of a comparison for creditors to see what the returns would be under either option. The restructuring practitioner does need to confirm that as far as they have determined, the company is eligible to continue with the SBR process, and as best they know can comply with the plan going forward. The acceptance period for the plan, once the creditors have received notice, is 15 business days. They have to vote on the restructuring plan. They can recast their vote during that period if they have a change of opinion for any reason. They just need to make sure that whatever their vote is at the end of that 15 business days is definitely the view that they want to take on the proposal. They have 5 business days to dispute the value of their debts listed in the schedule of debts that's reported to creditors. Now, just on that point, it is important to highlight that when a restructuring practitioner is appointed, they don't go off to creditors like they might do in a liquidation and get the creditor's view on how much the creditor is owed by the company. Under the SBR process, the restructuring practitioner is relying on the records of the company. So if for whatever reason the records of the company indicate that a debt owing to a creditor is different to what the creditor themselves believes is owed to them, then they need to make sure they step forward and notify the restructuring practitioner before the end of the first 5 business days to ensure that the correct amount of their claim is included in the SBR process. If that step isn't done and they, for example, their claim may be quite understated on the company records, then they will only receive a dividend under the proposal for the amount of their debt as per the company records. So it is very important that they come forward to get that fixed as soon as possible. Now, for the plan to be accepted, it does need to be accepted by more than 50% in value of responding creditors, noting that any related party creditors are not included in the vote. Now, that's a little bit different to other insolvency appointments that generally require a more than 50% in number and in value. With SBRs, it is simply more than 50% in value that are considered for the voting purposes. Okay, some benefits of the SBR process. Obviously, we've said directors remain in control of the company throughout the process. So that is a unique ability for an insolvency appointment. It gives the company to improve its financial and overall performance. Obviously, by the end of the process, if it is successful, then they're able to clear out a lot of their debts and really tidy up their balance sheet, moving into the next phase of the company's life. During the SBR process, there is a moratorium on unsecured creditors enforcing their debts. So it does give the directors some breathing space to try and get on top of their circumstances, deal with them and move forward without the pressure of creditors coming through as well. It does protect employee and creditor interests. Employees, obviously, because one of the criteria going forward is, or to be eligible rather, is that the company has to have paid its employee entitlements. So employees won't be out of pocket as they tend to be in quite a few liquidation appointments. They've paid up to date and not involved with the process at all. There is an agreed cost for the entire SBR process, so it's clear right from the outset what the fees will be paid to the restructuring practitioner, both for the initial, the fixed fee stage of the first stage, and then the percentage going forward to the completion of the plan. So it's all very well set out and everybody knows what to expect. And one of the key points about SBRs is that directors can actually avoid personal liability if they appoint a restructuring practitioner in the event that they've been issued with a non-lockdown DPN from the ATO. So the ATO revised the DPN, the non-lockdown DPN, to include the appointment of a restructuring practitioner as one of the options that can be taken to avoid personal liability if done within 21 days of receiving the DPN notice. Just a quick look comparing the SBR to the VA process. Obviously, with SBR, we've been through, there's quite a few eligibility criteria that must be met, and there's no way around those eligibility criteria. But with VAs, they're accessible to all companies as long as the company is insolvent. The SBR process can only commence through an appointment by the director, but VA obviously has a few other parties that can appoint a voluntary administrator. The process itself is a little bit longer, 35 business days to generally 25 if there's no extensions, but that extra few days is not material. The outcome itself, the plan is accepted. The company obviously continues on, returns to the director, whereas under VA, the outcome isn't initially known. It may end up that the company does get returned back to the director, but more often than not, it will either move into a deed of company arrangement or a liquidation if a deed of company arrangement cannot be put forward or is not accepted by creditors. And the cost of an SBR process is generally lower, fixed fee for the initial phase and percentage going forward, whereas under the VA process, it generally runs at a higher cost, and it does depend on the circumstances of the appointment, subject to creditor approval too, of course. Okay, just having a quick look at some statistics. So this is the corporate insolvency appointments for a number of financial years, sort of from COVID moving on. You see there was quite a dip in appointments. Everybody is aware of that for the financial year ended, the financial year of 2021. And since then, it has been increasing with quite a jump into FY23. Going into FY24, even to the 6 months, so these figures go till 31 December was last year. So even for the half year, you can see that it was exceeding so the half year, more likely to be the half year mark of FY23. So as we continue into FY24, that's only going to increase even further. So we do anticipate it being substantially higher than it was in 2023. Just on the right-hand side, you can see that even to the to 31 December last year, the number of restructuring appointments was at 489. Yet the entire financial year of 2023 was only 447. And for those of you who may receive the daily insolvency notices, the list of SBR appointments each day is quite significant. So that we are anticipating that come the end of this financial year, that number will be considerably higher than it has been since the process started. Court appointments too, quite a lot larger than they have been for the last few years, and that's largely to do with the ATO recommencing its winding up of taxpayers who have been delinquent, whereas the creditors' voluntary winding ups haven't been as much of an increase, but you can see there that they certainly at the half year mark looking towards being at least what they were for FY23 and potentially exceeding that as well. So this one here looks at the restructuring, so the SBR appointments from when they commenced back at the start of 2021 right through to the end of December last year. Now, clearly, the SBR process was either not well known or not well advertised, or not. A lot of entities may not have been eligible right at the start, and it was a very slow takeoff for the process. As people have gotten more information about how it works and can see it happening in other related entities, that number has significantly increased with each quarter that has passed. We're anticipating that the figures come the end of this quarter, in March 24, will be quite a lot higher than even December last year. So it is very exponential the way that it has been increasing since the process was implemented. Now, this is quite an important point for a lot of people. Unfortunately, we don't have any figures after the 11th of August last year yet. There hasn't been any more information released from the ATO. But this looks at the outcomes of SBRs that had occurred up to that point. And you can see that there is, around 92% of plans put forward that were accepted by creditors. And that's quite a significant point, particularly when a lot of the time the ATO is either the largest or the only creditor that is voting in relation to these proposals. There were a few that were terminated, and they were likely to be terminated because the eligibility criteria may not have been met. They might have been met initially, but as the process has commenced, the restructuring practitioner has determined that new information has come to light that makes them ineligible to continue with that process. Excuse me. There were, around 42 that had been rejected, and that may be for reasons that the liquidation process may be more beneficial to creditors, or the creditors weren't confident that the plan could actually be complied with by the company themselves. And whilst we don't know the outcome of those 18 that were pending at the time, they're probably going by the law of averages, they probably ended up into the accepted bundle, at least most of them. That's quite a large portion that are getting through. And as I say, the ATO was a majority creditor in almost all of those. So it is important that right from even before this process formally commences, the restructuring practitioner does pick up the phone and have some pretty robust conversations with the ATO, make sure that they receive all the information that they need to make a determination on the plan, and really gauge what the plan would look like to enable the ATO to approve that plan going forward. And we found that if you do open up those lines of communication right from the very start, the ATO has been very willing to enter into those conversations, and it has really assisted with a lot of those plans being accepted. The industries that have been involved with restructuring, is probably no surprise. Construction is leading the charge there. And a lot of that has to do with, at least in Queensland, and some other states may be similar, but in Queensland, the Queensland Building and Construction Commission don't see the SBR process as an insolvency process that results in the company's QBCC license being suspended. So it does give a lot of construction companies the ability to enter into this process, keep their license and continue trading. So that has been very useful for a lot of companies in that industry who are eligible to enter into that process. The other ones are accommodation and food services. That's, hospitality, we all know, is suffering quite a lot, and that will continue while interest rates remain high and discretionary spending is on the decrease. The other services there obviously aren't as popular for the SBR process as the first two. Nevertheless, there's been some appointments through all different industries that you can see. So achieving a successful restructuring process largely hinges on taking action early. The early action empowers directors to swiftly tackle challenges and optimising the company's prospects for success. It allows the timely implementation of cost-saving measures and minimises the disruptions for the company's team, its suppliers and its customers, and allows a smooth transition for the business through the entire process. All right, I might just stop here for a moment and just see, we've got some questions. Hi, will the creditor whose debt is understated in the company's books and records be subject to release of the whole of its debt on the effectuation of the plan? Thank you. That's a great question. The answer to that question is yes. So if the creditor hasn't corrected their claim and receives a dividend on the lesser amount that's known or advised on the company records, then that creditor will simply miss out on any of the balance of its debt that it may be owed. So it is very important that the creditor does get that fixed up, because they'll be missing out on potentially a large portion of their claim if they don't. It's a great question. Thank you very much. Okay, we'll move into some of the case studies that we've done here at Vincent's. The first one here is a company that is a family-owned concreting business. So a father and son have been trading the business for some 17 years, and they had employees, around 50 employees. So it wasn't considered a small business by any stretch of the imagination. The business itself was heavily affected by unseasonal rain, which created significant issues with the pouring of concrete by the company. Coupled with this, the prices of steel and concrete skyrocketed as a result of COVID. During that time and the months that followed, the price of raw materials in that industry effectively doubled, which caused the company's fixed price contracts to become very unprofitable. The company had amassed tax debts of more than $600,000, and then debts owing to the Office of State Revenue for payroll tax exceeding $70,000. So the debts were quite high. They had been making their tax lodgements on time, however, which meant that the ATO had issued the directors with a non-lockdown DPN. Given that it was a non-lockdown DPN, the directors had an ability then to appoint a restructuring practitioner to avoid personal liability if done within 21 days. So in order to keep trading, the company needed to retain its QBCC license, which meant that the voluntary administration process wasn't an option for it. The SBR then allowed them to continue trading, and that was essential to be able to meet the payments under the plan that they were going to propose. So the creditors of the company were just under $800,000 in this particular case, and as I say, a large portion of that being the ATO and the payroll tax that was outstanding. Key suppliers in this case had been mostly paid up to date, or if they weren't up to date, they were only up to the preceding month. So there wasn't a lot of unsecured creditors that were still owing at the time the SBR process commenced. The company proposed to pay an amount of $13,500 per month over a 12-month period, and that was to come from trading profits. So they put forward a lot of cash flow information to the ATO to help support the prospect of them being able to make the repayments under the plan. And the ATO was satisfied that they would be able to make the repayments based on the information, the plans that they put forward, and voted to accept that plan. That proposal and that plan have nearly completed. Nearly 12 months has gone through, and the company has been able to meet its payments each month since the plan began. And that's going to enable a dividend of around 18 cents in the dollar for the eligible creditors. So that was a very good result. So some of the key outcomes from this particular SBR is that because the reason why the company was experiencing financial difficulty was easy to identify, it's easy then to put plans in place to ensure that if the circumstances happen again, then the effect won't be as detrimental. In cases where the reason for the failure isn't quite as obvious, it does make it a little bit trickier to be able to convince creditors that the plan will result in them being able to continue forward without further issues arising. But in this case, directors were able to continue trading with their QBCC license, and the directors were also able to avoid personal liability by appointing the restructuring practitioner to undertake the SBR process. An important point too is that 50 or so employees were able to keep their jobs, with all their entitlements having been paid up to date, including superannuation. That's an excellent outcome for all of the employees involved with the company. The suppliers were able to retain a customer, so they weren't going to lose a paying customer going forward, which minimises impact on their own businesses. And also the ATO would retain a taxpayer, enabling them to receive further taxes going forward. I'll just have a stop here for another question. What, if any, obligations does the business executing the process have to disclose to future customers and creditors or potential investors that they are in the SBR process? As far as we are aware so far, there isn't any obligation to disclose it. And that's why it's important that if people are wanting to get into business or credit arrangements with entities, that they do a fair amount of due diligence now into who they're transacting with, just to see whether they have been through a process, likely to be going through a process because of a recent appointment of a restructuring practitioner, and that sort of thing.
I think, Ash, the key one here is though that the business will have gone into external administration, and on the PPSR, on the FX reports.
Yes.
So it's probably more that if you are going to do dealings with future creditors and they're going to do their credit control checks, that you might want to disclose that you were in a restructuring plan to be able to ensure that you sort of attack that head on rather than sort of them guessing that what was going on.
That's right. Yeah. So whilst there isn't any obligation, it's likely that it will come out in the wash. So it's good to get ahead of that and be sort of volunteering that information rather than it be a surprise for anybody on an Equifax report or a similar report. If the directors declare the company insolvent, enter an SBR, which is then terminated, where does that leave with the declaration of insolvency? Well, they have declared that it is insolvent, so it allows creditors then to proceed with seeking a winding up order if they want to outlay the costs of doing that, because the company has declared that it is insolvent, so it's opened up the floodgates for that potential action to happen. Okay, just a quick look at a second case study we have had here at Vincent's. This one was a data technology recovery company. In this particular case, the director of this company had been what we consider a repeat offender. He had been a director of a company that had been liquidated by Vincent's sometime earlier. And some of the debts that this company had incurred were a result of a related entity being placed into liquidation. So the company itself, it obviously operated a data technology company, and its primary business was the extraction of data from laptops, computers, mobile phones, and the like. Like with the previous example, majority of the creditors consisted of ATO debt, or being far and away the largest creditor on their list. In this one, though, the tax compliance, the lodgement compliance rather, hadn't been as great as the previous example. The director had been a little tardy with lodgements, but and we could still negotiate an acceptable outcome with the ATO and the creditors going forward that allowed the plan to be accepted. As the previous example, it allowed this particular business to continue trading into the future, and the company in this case put forward a contribution of 145,000 from future trading of the business, which in itself is going to enable a dividend of just over 20 cents in the dollar. I think that one was over a much shorter period than the last one. So that dividend is about to occur shortly. So that's a good outcome for those creditors as well. And it enabled creditors in this particular case to receive a return that was far greater than they were likely going to receive if the company had been placed into liquidation. And it also then enabled the company's employees to remain gainfully employed, which is always a great outcome for this process. So just some final tips before I pass over to Gavin so he can give some input into how his division can assist with this process also. It is important that the directors and the company take some time to evaluate the position of the company, seek assistance from an accountant to be able to analyse where things are really at. And create that list of creditors and debtors so you know exactly where the company stands. Clarify what you want to achieve by going through the restructuring process. If it is to the ability to continue trading and any other kind of appointment may adversely affect a license, or that's going to really help determine the correct process that you should go through. It's important to conduct an in-depth financial assessment to really pinpoint the areas that can be improved, and if there was a sort of trigger point for why the business ended up in financial distress in the outset. That's going to be important to be able to communicate with all creditors who may be subject to the SBR process, because they need to understand that this particular reason or issue won't be repeated, or if it may be repeated, what process can be put into place to minimise the impact if it does occur again. Okay, I'll see another quick question. Does this mean that there are no future ramifications or disclosure requirements for the director when applying for credit or trade credit accounts, etc.? As Gavin mentioned before, it's going to be evident on Equifax and other credit reporting agency reports. So there may be future ramifications. It does depend a lot on, I guess, the appetite of the entity that they are dealing with in the future. We have seen quite an increase in different entities struggling to accept or wanting to enter into transactions with companies that have had these sort of appointments in the past. And so it is important that that is a consideration that should be given, what impact it might have. However, we do see that generally if creditors are engaged right from the outset and they're aware of what kind of process or the process itself and what they're likely to get out of it, they are more willing to engage with it and accept with it, which hopefully would reduce the impact in the future on if they do apply for new credit accounts or a change to existing trade credit accounts. But it will be I guess, an issue raised by those entities if they do conduct those Equifax searches, and they are doing it at an increasing rate these days. Okay, well, I might hand over to Gavin. He's going to have a chat about what his division does and also how he can assist with the SBR process from before and during and after from a lending solutions.
Yeah, thanks very much, Ash, and very informative around the SBR process. It is quite a complicated process with a lot of sort of knickknacks around it. So it's really important to get in touch with a professional as quick as possible to make sure that you're giving the right advice to the client. As Ash touched on, I'm a director here at Vincent's and I'm in the Lending Solutions division, looking after mainly commercial and corporate debt for our clients, including debt advisory. Some of our services is business lending, equipment finance, debt advisory, and home and investment lending. And basically any lending that a commercial or consumer can require, we can assist with. In terms of the SBR, how we come into that is just having that deep knowledge in terms of distressed lending and how we can assist with that. I'll leave that slide up for a second just to sort of let people have an idea of all the different types of lending that we can achieve. When we're looking at distressed lending, though, it's really important to understand that pre and post an SBR, it's often an asset-based lend. So it's around the assets on the balance sheet or in the personal name. So whether that be plant and equipment, receivables, or property security. Now, when we're looking at funding sort of pre-SBR, it's really important to understand what we're leveraging and what we're doing with that fund. So it might be that we're leveraging some debt to pay out some creditors which are critical for the business moving forward. And if we know that there is going to be an SBR coming up in the next sort of 12 months, it's really critical that we pick the right bank to make sure that we have the right lender to make sure that we have the right story or narrative to go with that to ensure that the lender will support us through the SBR process. So it can be really tricky if you go to a lender and tell them everything is great and then all of a sudden try to enter into an SBR or some sort of insolvency event and tell them after the fact that yes, everything's still great, it's all part of the plan, but we just never told them. So it's really important that we sort of control that narrative and help them through that. I think a couple of questions that were around funding after an SBR. The credit history impact, it can be quite high. Having a business in external administration is a massive red flag for major lenders and tier twos, to be fair. It doesn't mean that they can't lend to it, but it needs to be a lot more due diligence from them. So with that, I think what we need to ensure is that we have a perception of stability for our clients or for the lenders from our clients. So with that, we control that sort of that narrative to be able to explain what the reasons behind the SBR was, what the changes that have happened to the businesses through the SBR. So during this process, it's not just a process of saying, okay, we've been able to reduce creditors from 100 cents to 20 cents in the dollar. It's more around we've identified why the creditors have got to where they are. We've put in a plan in place to be able to turn that around and make sure that moving forward that doesn't happen again. So I think it's really being able to convey that to the lenders is quite important. During the process, we may need to get the collateral value. So whether that be any property that we have, any plant and equipment, and do due diligence on our receivables ledger or anything else that may be on the balance sheet that has tangible value for us. After an SBR though, one of the great things is that your financial ratios look a lot better. You've wiped a lot of debt off the balance sheet and it does make your sort of balance sheet look a lot better going forward to a lender, which will make it look a bit more attractive. So it is important that we do continue that positive narrative about what we're doing moving forward, how we're going to assist or how we're going to commit to what we are with the lender. It is quite a different process when we are doing distressed lending. It's very important that that narrative to the lender is very succinct and it goes out to the whole market in the same way. What we do find is that often when clients get into a distressed lending situation, they will go to a finance broker, they'll go to an accountant and they'll go to a banker. and they'll tell them all bits and pieces. But the broker will then run with his own story to a couple of lenders. The accountant will run with their own story to another couple of lenders. And all of a sudden the message in the market is really mixed. And we can't really get lenders to sort of back it because they don't believe the message you're trying to say. So it's really important to control that from the start to ensure that we sort of are coming up with the correct narrative for a client in terms of how we're going to present this to the lender, and that we're all sort of on the same path going forward. So it's a really important process. There is lots of alternative lending. So traditional banks may be wary of lending to businesses post restructuring, but still is a lot of options out there, including fintechs, and they might be more open, albeit sometimes it is very much rate for risk. So you may have to pay a little bit more when you come outside of an SBR. And this all needs to be weighed in them conversations around what your future looks like in terms of the next 12, 24 months. Are we going to need debt? Is that going to blow this out completely from the future plans? So I think it's really important to engage a debt advisor. At the same time, you're sort of approaching your SBR or your practitioner, given that then you're able to make sure that you formulate that plan for the business together, all in one place. And control, it's really the big word in all of this, just controlling the information flow, the narrative, and the timelines and deadlines that need to be met. It's really important to be able to make sure that we can keep everyone, all the stakeholders, be the ATO, the creditors, or the trade creditors, and ensuring that that's able to all be in the one direction going forward. In terms of our advisory approach, what we like to do is review all the current facilities, corporate structure, current securities, current securities provided, analysis on the business, understanding the cash flow cycle, the risk analysis, and key management who is in the business and who's running it. When we assess all that, we like to make sure that it is positioned well for the business. If not, well, then we will sort of talk to the client about moving to a tender process where effectively we will put it together an information memorandum and bring that out to tender and the lenders. So effectively we'll write the credit for the lenders and we'll approach them with a tender process. We'll seek what is the best offers in the market for the client. So we'll go to generally, we sort of go to 3 to 5 lenders for each client. So we'll have used our own knowledge to select which lenders we think are the most important or the ones that are going to be able to support this client the best. And we'll go to market to identify the best results for them. We'll negotiate the terms and present indicative offers to our clients. And we'll make sure we strategize of what lender we're going to go. Sometimes it's not always right. Sometimes it's not always most cash. We just make sure that we're really understanding that process for the client, what they require. We'll complete the formal DD and finalize negotiations with the selected lender and make sure that documents are issued and reviewed beforehand. And then from then we help the client settle the facility, and post-funding we'll assist them in ensuring that the reviews are completed, covenants are tested for on time, and that the facilities are still fit for purpose. Because what we can find is post an insolvency event, that the first 12 months something was really critical for the business. After 12 months, the business might be performing quite well, and the facilities that are being put in place probably may not be fit for purpose anymore. So that close monitoring post funding after an SBR is really important, I think. So that's pretty much our sort of debt advisory approach and what we look to do. As I said, key things for a client who is in distress and looking for funding: early intervention, coming to ourselves at the same time that you are going to an insolvency practitioner is really critical to making sure that we can put a plan in place together to make sure that what the left hand is effectively talking to the right hand, that both plans marry up to ensure what the directors are trying to get from the outcome. But yeah, I think that's there might be one question there now. I'm not sure if that's an old one.
No, that's all good.
No, that's all good.
I think, Gavin, a key takeaway in all of this is because there are certainly lenders out there who will provide funding to assist with companies with the SBR process. What it does is it opens up a lot more availability for companies to become eligible for the process.
Yeah,
Because if, for example, their unsecured creditors do exceed that $1 million mark, there may be an ability for that company to get some finance, secured finance, depending on their circumstances, to sort of roll some or a lot of that excess unsecured debt over $1 million into a secured debt.
absolutely. And
And,
unsecured
you know,
debt isn't counted in
No.
in that 1 million, which is really important. So yeah, absolutely there is. I think the key requirement for that is probably an asset of some sort. It's really important that it is in distressed debt. It generally is asset-based lending and not sort of cash flow lending in its true form in terms of just on a multiple of EBITDA. So I think that's really, really key. But certainly we can leverage the balance sheet pre-SVR to be able to bring the creditors down or bring the critical creditors down. Because if you have like for instance, the concrete company that we had earlier, if they've got one main supplier to concrete and all of a sudden they're going to tell them that the 500,000 that they owe them is now 100,000, and they may not supply them moving forward. So being able to leverage some assets to be able to pay down that future or that supplier to make sure that we've got continuity of supply is really critical.
And securing funding for any sort of proposed payment under the plan is also there, depending again on what their circumstances are and whether there's some assets there to leverage. So
yeah, absolutely.
It's great to be able to have that as an option, because it does open up this process to even more entities if they have an ability to restructure and get that secured finance in place. All right. So that's what we have today. I haven't seen any other questions really pop through, but if there are any other questions, by all means pop them through. We will be able to send the slides around to you, all the attendees following this session. So if you do have any questions that you think of later, by all means get in touch. This last slide here has a whole raft of people, contact details there for people here at Vincent's who are involved in some way with SBRs and can assist with answering any of your questions. But I'd like to just take a moment to thank you all for taking the time to join us today. We've certainly enjoyed giving you the information, and we hope you have a great rest of your day.
Thank you very much, Ash, and thank you very much everyone for attending.
Thanks, Gavin.